Over the past decade, Vietnam has experienced remarkable economic growth, leading experts and policymakers to examine the reasons behind this extraordinary success. Factors such as effective government policies and significant foreign investments have played a role, but there's no single explanation for why Vietnam's economy has become one of the fastest growing globally. One notable aspect, however, is an indicator rather than a policy: government debt. This term refers to the total amount borrowed by a nation's government. In Vietnam's case, the government debt to GDP ratio, which compares a country's debt to its gross domestic product, a measure often used to estimate economic size, stands at approximately 39.6%. This figure places Vietnam's overall debt among the lowest in Asia. For comparison, neighboring countries like the Philippines and Thailand have debt to GDP ratios of around 60% and 59.6% respectively, while India's ratio exceeds 89%. Consequently, Vietnam's debt relative to its economy is quite low compared to many other Asian nations. This raises several questions about Vietnam's economic growth strategy, particularly how the country managed to expand without relying heavily on debt. Generally, debt is considered an essential tool for promoting growth in an economy or individual companies. While it carries inherent risks, various forms of debt can contribute to economic development. One might expect the Vietnamese government to utilize debt for purposes such as improving infrastructure or providing public goods. However, it appears that the government has not leveraged debt extensively in its approach to growth. Several factors contribute to Vietnam's restrained use of debt, but before delving into those, it's essential to grasp the general landscape of the country's government debt. The concept is quite straightforward. The Vietnamese government, like any other government or individual, can borrow money domestically and externally. Domestic borrowing can occur through instruments such as bonds, treasury bills, and loans from domestic banks. In contrast, external borrowing might involve partnering with bilateral sources like Japan or multilateral organizations, like the Asian Development Bank and the World Bank. Understanding why governments need to borrow is also crucial. Common reasons include financing government spending on infrastructure, public services, and social programs, managing budget deficits when expenses surpass revenues, and stimulating the economy during crises like the COVID-19 pandemic, when governments worldwide borrowed money to support their countries through various initiatives. Having established the context, we can now examine the composition of Vietnam's government debt as of 2021. According to data from the Ministry of Finance, Vietnam had $46.5 billion in external debt and $95.6 billion in domestic debt, totaling around $141 billion in outstanding debt for that year, a substantial sum. Much of Vietnam's bilateral external debt comes from Japan, which holds over $13 billion in loans to the country. South Korea and France follow, with $1.38 billion and $1.3 billion respectively. Among bilateral creditors, the World Bank is the largest lender, with $16 billion, trailed by the Asian Development Bank at $8.1 billion. This breakdown provides insight into the sources and scale of Vietnam's government debt, which has remained relatively low compared to other Asian nations despite these significant borrowings. Now we can address why Vietnam's government debt remains relatively low, despite the country's rapid growth. Various factors contribute to this situation, and some experts believe that low public debt has been key to Vietnam's success and post-pandemic resurgence. An article from the Friedrich Naumann Foundation for Freedom asserts that the country's low government debt enabled it to quickly recover as a strong economy after COVID-19. Additionally, while Vietnam's debt to GDP ratio is around 39.6%, numerous studies, including 36 out of 40 published by the Cato Institute, have found a statistically significant negative effect of public debt on growth. If these findings are accurate, they could explain why Vietnam's economy has flourished with low debt levels. At its core, Vietnam's low debt can be attributed to the country's rapid economic growth outpacing its borrowings. With one of the fastest GDP growth rates in the world, Vietnam has demonstrated fiscal discipline and cautious borrowing practices. The government has been diligent in promoting steady growth without relying heavily on debt. However, it is essential to note that some of Vietnam's debt originates from its state-owned enterprises, which does not directly reflect the government's overall debt position. This distinction is also a contributing factor to the country's low debt profile. For instance, while state-owned enterprises in Vietnam play a significant role in the country's economic development, particularly in sectors such as infrastructure, energy, and transportation, these SOEs have often borrowed money to finance their investments. However, since the debt of SOEs is considered separate from the government's debt, it does not directly impact the debt-to-GDP ratio that we've been discussing. But it is worth noting that the debt of these SOEs is as important as government debt. Because these SOEs play a crucial role in the economy, their financial stability has a direct impact on the country's overall economic health. A high level of SOE debt could potentially put a strain on the financial system, increasing the risk of default and lead to economic instability. One key instance is the Vinishin case. Vinishin, or the Vietnam Shipping Industrial Group, was a state-owned enterprise that experienced several financial difficulties and almost collapsed due to mismanagement and corruption. In 2010, the company defaulted on a $600 million international loan. This led to big loss of employment to the Vietnamese economy, a loss in taxation revenues, a further loss in the operation of state-owned enterprises, and more importantly, a downgrade in credit rating. Moody's Investor Service downgraded Vietnam's credit rating from B1 to Ba3 due to terrible issues related to the economy, but also citing Vinishin as part of the downgrade. A credit rating downgrade can have significant implications for a country. It can lead to higher borrowing costs, reduced access to international capital markets, and a decline in investor confidence. It's important to consider not just the amount of debt a country has, but also its ability to repay that debt. Countries like Japan, with a debt-to-GDP ratio of over 264%, can sustain high debt levels because they can repay their obligations. The question then arises, can Vietnam repay its debts effectively? From a domestic perspective, Vietnam holds about $95.4 billion in debt. Domestic loans are generally easier to manage than external loans, as they reduce currency risks and enhance fiscal sovereignty, among other benefits. Some economists even argue that countries can print money to pay domestic debts. Although this approach has its risks, repaying domestic loans is usually more manageable, because governments can use tax revenues, raise funds from other sources, or print money. When it comes to external debt, the situation becomes more complex, as it involves currency risks, higher borrowing costs, and vulnerability to external shocks. To repay external debts, countries can use their foreign reserves. At the time of writing, Vietnam's foreign reserves stand at about $83 billion, nearly double its external debt. This suggests that Vietnam is managing its foreign borrowings effectively. In addition to using foreign reserves, the Vietnamese government can finance its external debt through various means, including export earnings, debt refinancing, and possibly debt restructuring. Now, it's worth exploring the reasons behind the government's limited use of debt in promoting economic growth. Firstly, Vietnam's export-oriented economy has played a significant role in its low debt levels. By focusing on exports, the country has attracted substantial foreign investment and experienced rapid economic growth. This has led to a consistent flow of foreign exchange earnings, which in turn has helped Vietnam manage its external debt more effectively. Efficient public expenditure is also a key factor. The Vietnamese government has made it a priority to allocate its spending in sectors with the highest potential for growth and social benefits. This focused approach has optimized government spending and reduced the need for excessive borrowing. Macroeconomic stability is another vital factor. Vietnam has managed to maintain a stable macroeconomic environment, characterized by low inflation, a stable exchange rate, and sound fiscal policies. This stability has made it easier for the government to manage its debt and maintain a low debt-to-GDP ratio. Finally, structural reforms and economic liberalization have played a part in Vietnam's success. The country has undergone significant reforms and liberalized its economy over the past few decades, leading to greater efficiency, productivity, and competitiveness. These reforms have contributed to Vietnam's rapid economic growth and reduced its reliance on debt financing. In conclusion, it's essential to consider future expectations, as developing countries often experience increased public debt as they progress towards becoming developed nations. In some cases, their debt-to-GDP ratio may exceed 100%, with public debt surpassing annual output. Will Vietnam follow a similar trajectory if it becomes a developed country? Predicting the future is always uncertain, but it appears that the Vietnamese government has not relied on debt as heavily as other nations. This tendency may continue in the long run, notably during the COVID-19 pandemic, when many countries saw their debt to GDP ratios increase by 10 to 20%. Vietnam's ratio only rose from 41.5% in 2019 to 41.8% in 2020, before dropping below 40% the following year. Given that 2020 was a challenging year globally, Vietnam's performance in managing its debt seems impressive. But anyway, do let us know what you think. Thanks for watching.